Hello, this is Josh Frank from Center for Responsible Lending, senior researcher and author of the report Predatory Credit Cards, Unsafe, Unsound for Consumers and Companies. Welcome to the webinar for this research report. The new research CRL conducted shows that practices in credit cards that are harmful for consumers are also harmful for the bank. It shows that consumer safeguards don't conflict with bank safety and soundness, rather that the two go hand in hand. It shows that what's bad for consumers is also bad for business, and it gives evidence beyond evidence we've already found in prior reports that the Credit Card Act worked. We looked at 23 pricing and marketing practices that were common among the top 100 credit card issuers in the summer of 2009, or at least they were common. And this was just before the Card Act took effect. These practices, I'm going to discuss them in a little more detail, but they all were, some of them have been outlawed by the Card Act, some of them haven't. We also looked at other data, including credit losses for these companies in the 2006 through 2010 period for the top 100 issuers. Examples of the deceptive practices we looked at include hair triggers for penalty rates. And what I mean by that is a hair trigger would be a penalty rate that often, by the way, would double the rate. Somebody's normal rate might be 14%, and they'd go to a rate that was 30%. That was a pretty typical jump, so more than double the rate. And these could be triggered by a hair trigger in many cases, in many issuers, for very minor infractions, such as being a day late. And at the time, a lot of issuers were doing manipulations to actually cause consumers or create more situations where consumers would be a day late. So that was a common practice. It was a hair trigger penalty. Another type of penalty rate would be a universal default, or another trigger, which is imposing a penalty rate even when the consumer is paid on time or didn't go over a limit or anything like that, but were late with another issuer, or even just had a revolving balance or credit score outside of their interaction with that particular issuer that caused the issuer to put them at a penalty rate. Manipulating the indexes to calculate rates to the disadvantage of cardholders was another practice we included. Now, we talked about this practice before in a report we called Dodging Reform. And Dodging Reform, in Dodging Reform, we call the practice Pick a Rate. Dodging Reform, by the way, as well as the current report, are available on our website, www.responsiblelending.org. You go to the credit cards tab or the research area and find both reports. So what this practice is basically taking the maximum rate over a long period of time for the index rather than using the current rate for the index. And this allowed, as we showed in Dodging Reform, issuers to charge higher rates to consumers and artificially inflate the finance charges. Another practice is assessing late fees with no relation to default risk. Another practice is high minimum finance fees, such as a $2 minimum finance fee for a penny balance. Minimum finance fees are basically when interest rate can't go below a certain amount. So, for example, let's say somebody had a $10 balance and they had a 12% in APR. Well, for each month, if with a 12% APR, they'd be charged 1%. So, for a particular month, they pay 1% of $10, and 1% of $10 would be 10 cents. However, with a minimum finance charge of $2, which some issuers did, instead of 10 cents, they would pay $2. We looked at not just bad practices, but also better practices in our data. Some examples of better practices are here. One would be a limit to fees for cash advances. So a lot of issuers these days have a floor and or ceiling for cash advances and balance transfers. A limit, what we talk about here, is a same thing as a ceiling. So a floor is when a fee is never less than an amount. So let's say the minimum fee is $20. That would be a floor, and that's bad for consumers because they pay more even if they take a very small cash advance or balance transfer. A ceiling is an amount that the fee is never more than, which is good from a consumer's perspective. Let's say a consumer has a $20 ceiling on their cash advance fee at a consumer-friendly issuer, and they take a $2,000 cash advance and have a 3% fee. 3% of $2,000 would be a $60 fee normally, but if they have a $20 ceiling, they only pay $20 instead of $60, saving the consumer a lot of money. So that would be a consumer-friendly practice. No high-cost penalty interest rates are another example of a consumer-friendly practice. That we looked at both the presence of penalty interest rates and the amount of the jump in the interest rate. So both dimensions, whether they're high cost and whether they exist, were factors here. More time after due date before charging a late fee is another example of a consumer-friendly practice. So what this would mean is that there would be a due date, and that due date would matter for when a consumer would start paying interest on the balance based on when they pay, but a late fee is not charged right away. Some consumer-friendly issuers gave an additional period before a late fee is actually assessed. And a longer grace period before interest is charged is another feature that some consumer-friendly issuers had. So there was wide variations in the practices and other variables we tracked. Here's some examples, and what we're looking at here is dividing the issuers into quintiles, which is basically 5 groups. And so here's basically the midpoint, the middle of the bottom quintile and the top quintile in terms of consumer-friendly practices. You could see that the BBB, Better Business Bureau complaints are one thing we tracked, and you could see there's a big difference in the bottom and top quintiles and how they performed in complaints. Maximum late fee is another practice, or a practice. Complaints aren't really a practice, but they are something we tracked for as an actually statistical result, which I'll talk about later. One thing we compared practices to was complaints. The maximum late fee would be a practice we looked at, and you could see there's a big difference in the quintiles, the top and bottom quintile. And the cash advance checks mailed is another practice we looked at. It's a sign of a really aggressive issuer if they're mailing a high level of cash advance checks, and which generally aren't very good for consumers to have those aggressively marketed to them. And you could see there's a very big difference in the best practice and worst practices group in the cash advance checks mail. The scoring system we used to rate the practices was not one that scaled good and bad practices arbitrarily or based on our judgment. It was a technique called factor analysis. And that means we didn't actually know what we would get, what kind of dimensions we would get coming out of it. It's something that doesn't rely on the researcher's judgment, but tallies variables based on their similarity and how they group. In other words, if an issuer has practice A, are they likely to have practice B? And are they likely to have practice C? And it looks for those natural clusters and groupings of practices that issuers have. And typically, what happens with factor analysis is you get multiple dimensions. It's structured to create multiple dimensions. And in this kind of scenario, the dimensions likely would be based on market niches. So maybe all the subprime issuers have practice A, B, and C. And that would be along one dimension in the factor analysis, the way it comes out. Maybe rebate issuers or affinity issuers have practice D and E commonly, and that would come out as another dimension. That's the way factor analysis typically occurs, and so on. There'd be 3, 4, 5, 6 and so on dimensions. But we didn't get that at all. What we got was one dimension. And the one dimension was quite clear. It was about good and bad practices. In fact, we had separately created our own scale to rate what we thought were good and bad. And it was virtually identical to the dimension that came out of the factor analysis. And again, the factor analysis is something that does not rely on our judgment in terms of what the dimensions are and how they're scored. It naturally falls out of the data. And what we found was good issuers tend to have, if an issuer has one good practice, they tend to have many good practices. If an issuer has one bad practice, they tend to have many bad practices. And that's the only dimension that came out as important. There weren't these market niches in terms of type of issuers, in terms of their practices. There were just consumer-friendly issuers and there were consumer-unfriendly issuers. As I said, we found that issuers with one unfair and deceptive tactic tended to have many. We also found that these practices were linked to the lender's type and size. Larger issuers tended to have worse practices. Credit unions, regional banks tended to have better practices. These were not universal. Sometimes there was a credit union that rated low or their practices, or let's say a large issuer that rated higher. But there were some strong tendencies for large issuers to have worse practices and for credit unions and regional banks to have better practices. We also found that Better Business Bureau complaints were linked to certain practices regardless of the issuer type or size. In particular, there were more complaints if an issuer had worse practices, and that was not, any link to size or type was secondary. In other words, it was driven by the fact that practices were linked to size or type. When you have practices in the mix, type and size of issuer don't drive complaints. Bottom line, what we found when we looked at credit losses and practices, we found that the issuers claimed that high costs and fees and interest were risk management tools as false. Instead, the fees and rates, the practices, these deceptive practices didn't mitigate risk, they became the risk, they amplified. In terms of credit losses, what we found is the more a bank engaged in consumer unfriendly practices, the bigger its jump in credit losses during the downturn. Going into the recession, the jump in losses was not related to the institution's size or type, or the initial loss rate did not predict the change in credit losses. What it was more driven more than anything else by practices. Practices was linked most strongly to a jump in credit losses. So this has important safety and soundness implications. Bad practices cause a jump in credit losses during a downturn. It creates financial vulnerability to the whole system. These practices do. The best predictor of losses during the downturn, and the jump in losses in particular, was the practices used by the bank and how consumer friendly or unfriendly they were, with unfriendly practices being associated with a bigger jump in losses during the downturn. By the way, we did do a different version of the score for practices that took out any kind of practice that at all could be used as a method of mitigating risk. And we got exactly the same result. So it's not that practices were used to mitigate risk and therefore this association. No, it's the practices that led to the risk. This gives a better sense of just how important practices are in predicting losses. These are not particular issuers, but they are based, these numbers here are based on the real data, the real regression of results. So this takes an issuer who's in the 10th and 90th percentile in terms of their score, their UDAP score, their score on their practices. And so there's a safe issuer and an issuer with deceptive practices. again, in the 10th and 90th percentile of the score. So the issuer in the 10th percentile, they start with a 3.2% pre-recession loss rate. They do have a jump, but it's only to 5%. And this is based, again, on our regression results, our statistical analysis. If you have an issuer who has deceptive practices, they start again at 3.2%. But that issuer will have a jump during the recession to 11.3%. This is obviously a very dramatic difference and a very important difference for the safety of the banking system. If issuers only jump from 3.2% to 5%, then there's much less risk for the financial system when things get bad. However, if 3.2% to 11.3% is a jump because issuers have a bad set of practices almost universally, then what you'll find is that will cause the crisis, any downturn, to get worse. It will cause, even if the credit card industry was not the cause of the crisis, it will cause the crisis to get exacerbated and to cause more financial damage. We found that happier customers means healthier banks. We found that consumer safeguards don't conflict with bank safety and soundness, rather the two go hand in hand. We also found that what's bad for consumers is bad for business. And we found more evidence that the CARD Act works. This concludes the presentation. Thank you for listening. And if you want more details on the report, please go to our website, which is on this page, www.responsiblelending.org.